So here's a question we've all probably heard in India. It's the ultimate financial showdown. When you're trying to build some serious wealth, where should your money go? Stocks or real estate? Today, we're going to settle this debate, but with some real numbers.
Okay, let's put you in the driver's seat. Just imagine you've got 10 lakh rupees sitting in your bank account, ready to be invested. What do? Do you dive into the stock market, or do you use it to put a down payment on a property? Believe it or not, this one choice could mean a difference of crores down the line. You know, for generations, what have our parents and grandparents told us? That real estate is the king. It's safe, it's tangible, you can touch it, but the actual math tells a much more complicated story. So let's peel back those layers and see what the data really says.
All right, round one. Let's start with the most simple, straightforward comparison you can make: pure head-to-head returns. If we just ignore everything else for a moment, no loans, no tenants, no nothing, which one has actually grown faster over time?
Well, when you look at the long-term data in India, a pretty clear picture starts to form. On one side, you have stocks, let's say an index fund that just tracks the top companies, which have historically given back about 12 to 15% a year on average. On the other side, real estate, even when you add up the price increase and the rent you collect, usually lands somewhere between 7 and 13%. So yeah, on pure numbers alone, stocks kinda have the edge.
And just to make that real for you, if you took your 10 lakhs, put it in the stock market, and it just grew at an average of 12% a year, in 20 years, that investment would be worth around 96 lakh rupees. And think about it, that's a pretty hands-off way to multiply your money almost 10 times. But that is not the whole story, not even close.
And this brings us to real estate's secret weapon, the one thing that completely flips this entire conversation on its head. It's a little something called leverage.
See, here's the absolute crucial difference. When you invest in stocks, your 10 lakhs buys you, well, 10 lakhs worth of stocks. It's a one-to-one deal. But in real estate, oh, that 10 lakhs is so much more. It's the key that unlocks a much bigger asset.
For example, that 10 lakh down payment could let you get a loan from the bank and buy a property that's actually worth 50 lakhs. All of a sudden, the game has changed. You're not earning returns on just your 10 lakhs anymore. You're earning returns on the entire 50 lakh property.
And that, my friends, is the magic of leverage. You're using someone else's money, the bank's money, to blow up your potential gains. Think about it. Even if that 50 lakh property only goes up by 7% in a year, that's a 3.5 lakh gain. But you only put in 10 lakhs. That's a whopping 35% return on your own money in just the first year.
So what happens if we play this out over the long term? Let's say you buy that property, and for the next 20 years, your tenant's rent is basically helping you pay off that bank loan. At the end of it all, that whole asset is yours, free and clear.
And here's the punchline. After those 20 years, that property you bought for 50 lakhs could now be worth somewhere between 1.5 to 2 crore rupees. Now that number just blows the 96 lakhs from the stock market out of the water. But of course, there's always a catch, isn't there?
Those big headline numbers are super exciting, but they don't really capture what it's like to own these things day to day. So, let's get into the reality check and see how these two investments actually stack up in the real world.
And this table just lays it all out, crystal clear. Stocks are easy, they're passive. You can buy or sell them in seconds from your phone, and you can literally start with 500 rupees. Real estate is the complete opposite. It's an active job, finding tenants, fixing leaks. It's super illiquid, meaning it can take months to sell. And you've got constant costs like maintenance and taxes that can nibble away 1 to 3% of your property's value every single year.
So to sum up stocks, the pros are obvious: great potential for returns, super flexible, and very low effort. The big downside, volatility. The market goes up and down and it can be scary. Honestly, the biggest risk with stocks is you, panicking during a crash and selling at the absolute worst time.
Now for real estate, the pros are powerful. No doubt, you own a real physical thing. It's a great protection against inflation, and there's some really nice tax benefits. But the cons are serious. It is a ton of work, it ties up a huge chunk of your money, and everything, I mean everything, depends on that one thing: location, location, location. So, after all of that, where do we land? What's the final verdict here? Is there a clear winner, and what's really the smartest way for you to build your wealth? Let's put this all together.
The honest truth is, there is no single winner. It really depends on you. Stocks are perfect for someone who wants a hands-off approach and values being able to get their money out quickly.
Real estate can give you those incredible leveraged returns, but only if you're willing to put in the work. The smartest strategy, though, isn't about choosing a side.
For most of us, the best approach is simply to do both. You diversify. A really balanced portfolio might have about 60 to 70% in stocks and mutual funds for that high growth and liquidity, and then maybe 30 to 40% in real estate for stability, cash flow, and that leverage effect. That way you get the best of both worlds.
At the end of the day, the right path really depends on your own goals, how much risk you're comfortable with, and frankly, how much work you're willing to do. So the real question isn't which one is better, it's which combination of these assets is going to build the future that you want.